Have you ever wondered why the market suddenly explodes after a central bank speech? Why gold spikes? Why currencies crash? Why stocks rally or drop within minutes? It all comes down to one thing: central bank policy. Central banks are some of the most powerful institutions in the world. Their decisions control liquidity, influence interest rates, and shape economic conditions globally. Let's break it down simply. What do central banks actually do? Most central banks have three main goals: keep inflation under control, support economic growth, and maintain financial stability. To achieve this, they use three main tools. First, interest rates. This is their most powerful weapon. When a central bank lowers interest rates, borrowing becomes cheaper. Businesses expand, consumers spend more. This usually boosts stock markets. But when rates increase, borrowing becomes expensive. Spending slows down, inflation cools. Higher rates often strengthen a currency, but can pressure stocks and gold. This is why traders watch rate decisions like hawks. Second, quantitative easing, QE. This is when central banks inject money into the system by buying bonds. More money in the system equals more liquidity. More liquidity equals more risk-taking. QE often supports stocks, commodities, and gold. But it can weaken a currency due to increased money supply. Third, forward guidance. This is communication. Sometimes markets don't move because of what the bank does, but because of what it says it might do. If a central bank signals future rate cuts, markets may rally before it even happens. Expectations move markets just as much as action. How does this impact different markets? The stock market. Lower rates usually support stocks. Higher rates can slow them down. The bond market. Rate hikes push yields higher. Rate cuts push yields lower. The Forex market. Currencies react strongly to rate differences between countries. Gold often benefits from lower rates and economic uncertainty. This is especially important for traders in pairs like XAU-USD. What is news trading? News trading means taking positions before or right after major announcements. Traders anticipate volatility around interest rate decisions, inflation data, employment reports, and central bank speeches. But here's the reality. News trading is high risk. Spreads widen, price spikes. Slippage happens. Markets can move in both directions before choosing one. That's why risk management is critical. Final thoughts. Central banks don't just influence markets, they drive them. If you want to become a better trader or investor, you must understand interest rates, liquidity, and market expectations. Because behind every big move, there's usually a policy decision or economic signal driving it. Stay informed, trade smart, manage risk, and remember, the market reacts to money flow, not opinions. If you found this helpful, subscribe for more educational market breakdowns. See you in the next one.